Most people believe economic collapses happen suddenly. A crash, a panic, a headline that changes everything overnight. But history shows something very different. Economic collapses don't begin with chaos. They begin when everything looks stable, when markets are rising, when optimism is high, when risk feels distant. That is often when the system is most fragile. The Great Depression, Japan's lost decade, the Asian financial crisis, the 2008 global financial crisis. Different countries, different decades, same structural pattern. This is not about prediction, it's about pattern recognition. And once you understand the structure beneath economic systems, you stop reacting to headlines and start seeing the machinery underneath. Section 1. Prosperity before collapse. The first warning sign appears during prosperity, not during panic. Before 2008, housing prices were booming. Before the dot-com crash, technology stocks were unstoppable. Before the Great Depression, the 1920s were called the Roaring Twenties. Expansion creates confidence. Confidence reduces caution. And when caution disappears, fragility increases. People stop asking, "Is this sustainable?" They start asking, "How do I participate?" That psychological shift is the beginning of instability, because prosperity changes perception. Risk feels smaller than it actually is. Section 2. Excessive credit growth. The second warning sign is aggressive debt growth. Every major collapse in modern history was preceded by rapid debt growth. Consumer borrowing increases, corporate leverage builds, governments expand fiscal commitments. Debt creates acceleration, but acceleration without structural balance creates vulnerability. An economy heavily dependent on leverage cannot absorb shocks efficiently. It amplifies them. Interest rate shifts become crises. Liquidity tightening becomes contagion. Debt feels like growth until repayment begins. Section 3. Asset price detachment. When prices rise based on narrative rather than productivity, instability forms quietly. This time is different. New technology changes everything. Permanent growth cycle. These phrases appear in every bubble. Markets shift from valuation to momentum. Momentum shifts to speculation. Speculation shifts to exposure. And exposure becomes systemic risk. When prices disconnect from reality, correction is not emotional. It is mathematical. Knowledge mismatch, the hidden layer. There is another structural element that often accelerates collapse: knowledge mismatch. Systems evolve faster than public understanding. Technology accelerates. Financial instruments become more complex. Markets become more automated. But financial literacy does not increase at the same pace. This creates asymmetry. Institutional systems operate algorithmically. Individuals react emotionally. That imbalance magnifies volatility. Technology acceleration reality. We are now in a period of rapid technological expansion. Artificial intelligence, automation, algorithmic trading, digital finance infrastructure. Technology itself is not the risk. The mismatch between technological speed and human adaptation is. When efficiency improves faster than workforce transition, economic pressure builds. Productivity rises. Stability does not automatically follow. Every major technological shift in history created wealth. It also created disruption. The Industrial Revolution, the Information Age, now the Algorithmic Age. Different tools, same structural tension. Psychology and speculation. When markets fall, people become cautious. When markets rise, people become confident. The fundamentals may not change dramatically, but perception does. That is the power of financial psychology. Speculative cycles repeat because human behavior repeats. Crypto surges. Equity surges. New narratives emerge. Technology evolves. Human emotion does not. Fear and greed remain constant variables in every economic era. Wealth concentration and fragility. Late-stage expansions often increase wealth concentration. Asset holders benefit most from rising markets. Wage earners benefit more slowly. When contraction begins, those without buffers absorb the greatest impact. The middle class historically experiences the deepest structural strain during downturns, not because of poor decisions, but because of exposure. Mortgage exposure, retirement exposure, employment exposure. Liquidity determines resilience. Optimism does not. The most dangerous period is not visible panic. It is visible calm. Low volatility, strong headlines, fast recoveries after dips. That environment creates overconfidence. Overconfidence increases leverage. Leverage increases fragility, and fragility remains invisible until stress is applied. Structural reality. This is not market forecasting. It is structural literacy. Economic collapses are not random. They follow sequences. Prosperity, leverage expansion, narrative-driven pricing, knowledge mismatch, technological acceleration, psychological overconfidence. The form changes, the pattern repeats. Closing continuation, strong but calm. The next economic disruption will not look identical to the last one. It never does.